Today we are going to talk about Chapter 9, Accounting for Receivables. There are three types of receivables: notes receivables, accounts receivables, and a statement presentation of receivables. Account receivables are accounts owned by customers on account. The three primary accounting issues are as following: recognizing, valuing, disposing. When a business sells merchandise to a customer on credit, debit account receivable, credit sales. When a business receives returned merchandise previously sold to a customer on credit, debit sales returns and allowances, credit accounts receivable. When financing charges are added to a balance owing, debit accounts receivable, credit interest revenue.
Now I'm going to introduce valuating accounts receivable. Once receivables are recorded in accounts, the next step is to report those receivables on the balance sheet. However, some receivables will be uncollectible. All the credit losses are debited to a new account, which is bad debts expenses. There are two methods are used in accounting for uncollectible accounts. The first one is the direct write-off method, and the second one is allowances method. First, direct write-off methods of uncollectible accounts. Under this method, when receivable is determined to be uncollectible, the loss is charged to bad debts expenses and credit accounts receivable. An example entry is as follows. The direct write-off method is not acceptable for financial reporting purpose because it does not show accounts receivable in the balance sheet at the amount actually expected to be received. The other one is allowance methods for uncollectible accounts. The allowance method is required for financial reporting purpose. Uncollectible accounts receivable are estimated, and the estimated uncollectible are debited to bad debts expenses and credited to allowances for doubtful accounts. The example is showing the adjusting entry to record the estimated uncollectible accounts. Remember, it is just estimated. When all means of collection a past due account have been exhausted and collection appear impossible, the account should be written off. So next step is recording the write-off and uncollectible account. Here is an example. An actual uncollectible amount is debited to allowance for doubtful accounts and credited to accounts receivable. Occasionally, a company can collect the uncollectible money after the account has been written off. In this time, two entries are required to record the recovery of a bad debt. First, the entry made in writing off the account is reversed to reinstate the customer's account, and the second, the collection is generalized in the usual manner. The example is as follows. Note that the recovery of a bad debt affects only balance sheet account. Next, we are going to the basis used of allowance method. In real life, companies must estimate the amount of expected uncollectible. Two bases are used to determine this amount. The first one, percentage of sales, and the second one, percentage of receivables. The percentage of sales basis results in a better matching of expenses and with revenues, an income statement viewpoint. The percentage of receivable basis will produce the better estimate of net realizable value, a balance sheet viewpoint. In the percentage of sale basis, management indicate what percentage of credit sale will be uncollectible. This percentage is based on past experience and anticipated credit policy. Under the percentage of receivable basis, management establish a percentage relationship between the amount of account receivable and the required balance in the allowance account. This percentage can be applied to the total accounts receivable balance or to the individual accounts receivable balance stratified by age. Here is an example. The accounts of receivable are separated in different categories by number of days outstanding, and different percentage applied on different category. For example, 0 to 30 days is 2%, and 31 to 60 days is 4%, and so on.
Disposing accounts receivables. A factor buys receivables from businesses for a fee and collects the payment directly from customers. Credit cards are frequently used by retailers who wish to avoid the paperwork of issuing credit. Three parties are involved when credit cards are used in making retail sales: the credit card issuer, the retailer, and the customer. The retailer pays the credit card issuer a percentage fee of the invoice price for its services. Sales from bank cards are treated differently than sales from non-bank cards. Bank card sales. When the sale is transacted, the bank immediately adds the amount to the seller's bank balance. For example, A purchases a number of CD from B company for $1,000 using her Royal Bank Visa card. The service fee is 3.5%. Therefore, you debit cash and credit card expenses. Then you credit sales to record Visa credit on sale. Conversion into cash does not occur until American Express remits the net amount to the seller. Assume that Major Music accepts an American Express card for a $1,000 bill. The service fee is 3.5%. The only difference for non-bank card sales is that you debit accounts receivable instead of cash.
Lastly, we will have accounts receivable, which is presented by me. So, has anyone heard of the promissory note? Define term promissory note. A promissory note is a written promise to pay a specified amount of money on demand or at a definite time. The party making the note is the maker, and the party to whom payment is made is called the payee. The interest-bearing note equation is as follows. Face value of note times annual interest rate times in terms of 1 year. Interest rate specified is an annual rate of interest. Now we will move on to recognizing notes receivable. To start off, here is an example for notes receivable. Roma Company receives a $1,000 6% promissory note due in 2 months from Brent Company to settle an open account. Continuing on, like accounts receivable, short-term notes receivable are reported at their net realizable values. The notes receivable allowance account is allowance for doubtful notes. A note is honored when it is paid in full at its maturity rate. Here is an example for an honored notes receivable. Water Co. lends Higley Inc. $10,000 on June 1st, accepting a 4.5 interest-bearing note due in 4 months on September 30th. Now moving on to the opposite. A dishonored note is a note that is not paid in full at maturity. It is also no longer negotiable, and since the payee still has a claim against the maker of the note, the balance in notes receivable is usually transferred to accounts receivable. Here is an example for dishonored notes receivable. As everyone can see, accounts receivable is debited instead of cash for Higley, since Higley has yet to pay the amount due. Lastly, we will be going over the balance sheet presentation of receivables. Each of the major types of receivables should be identified in a balance sheet or in notes to financial statements. Short-term receivables are reported within the current assets section below cash and temporary investments. And both the gross amount of receivables and allowances for doubtful accounts should be reported. Financial ratios are calculated to evaluate the short-term liquidity of a company. These ratios will be taught in Chapter 19. We thank you for listening, and we hope you've learned something about accounts receivable today.
Created using Powtoon.